students, I welcome you all for the online class of Business Studies. Today we will be continuing the investment decisions once again. Let us have the investment decisions or the capital budgeting decision importance we will be continuing. Capital budgeting decision can turn the fortune of a company. The luck of a company can be changed easily with the help of the capital budgeting decision. The capital budgeting decisions are considered very important because of the following reasons. Very first, long-term growth. The capital budgeting decision affects the long-term growth of the company. Has fund invested in the long-term assets bring return in future, and future prospects and growth of the company depends upon these decisions only. Whenever we want to do any investment, for that investment will also help us to know in the future how much investment we can do. So long-term growth, capital budgeting decisions affect the long-term growth of the company because the major decision related to the big investment is taken in this investment decision or the capital budgeting decision. So it plays a very vital role. Whatever investment decision we are taking, it must be taken with a proper way. Have fund invested in long-term asset, they bring the return in future, and future prospects and growth of the company depends upon this decision only. Large amounts of funds are involved. Investment in long-term projects or buying of fixed assets involve huge amount of funds, and if wrong proposal is selected, it may result in wastage of huge amount of funds. That is why capital budgeting decisions are taken after considering various factors and planning. Risk involved. The fixed capital decision involved huge funds and also big risk. Because of that, the return comes in long run and company has to bear the risk for a longer period of time till the returns start coming. So it involves a larger risk. Long-term growth. Large amount of funds involved, that makes the importance of capital budgeting decision. Risk involved is very more because in this particular decisions, whatever the risk which is involved, we have to take fairly because one the time investment is done, it is irrevocable, it is irreversible, it cannot be refunded back. So all the investment decision what we are taking, it must be taken with a proper due and care and because as the return comes in long run and company has to bear the risk for a longer period of time till the returns start coming. Irreversible decision. The capital budgeting decisions cannot be reversed or changed overnight. As this decision involve huge funds and heavy cost, and going back or reversing the decision may result in heavy loss and wastage of funds. So this decision must be taken after careful planning and evaluation of all the effects of that decision, because adverse consequences may be very heavy. So this is irreversible decisions of the business. So capital budgeting decision, whenever we are taking, it cannot be reversed or changed overnight. It must be think before investing. After investing, we cannot do anything with the decision because as it is irreversible, irrevocable. Once we have did the investment, it has to be fulfilled. Whether after that we can come to know that it is a lost decision, but still we cannot do anything. So it is very important to take investment decision with proper due care and care. Next is the financing decision. After investment, students, the next decision is financial decision. Financing decision, it is known as financing decision. Student, we will learn how to do the best way we have to arrange the finance for the business. Financing decision involves all those decisions which will help to make the capital formation of a company. This investment we are doing for our own business, not for other projects or not for other type of asset purchase. That's why it is known as financing decision. The second important decision which finance manager has to take is deciding source of finance. A company can raise finance from various sources such as by issue of shares, debentures, or by taking loan and advance. Deciding how much to raise the fund from which source is concerned of financing decision. Mainly sources of finance can be divided into two categories. One is owner fund and second is borrower fund. When we talk about owner's fund, the fund which is invested by the owners of the company, it is known as owner fund. Share capital and retained earning constitute owner's fund, and debentures, loans, bonds, etc. constitute borrowed fund. The main concern of finance manager is to decide how much to raise from owner's fund and how much to raise from the borrowed fund. While taking the decision, the finance manager compares the advantages and disadvantages of different sources of finance. The borrowed fund have to be paid back and involve some degrees of risk, whereas in owner's fund there is no fixed commitment of repayment and there is no risk involved. but finance manager prefer a fix or mix of both types. Under financing decision, finance manager fixes a ratio of owner's fund and borrowed fund in the capital structure of the company. Factors affecting financing decision. While taking financing decision, the finance manager keeps in mind the following factors. Very first, cost. Second is risk. Cost, when we see the cost of raising finance from various sources is different, and finance manager always prefer the source with minimum cost. Risk, when we say more risk is associated with borrowed fund as compared to owner's fund. Security. Why? Because owner's fund, when we say, when it is the money of the owners of the, they will not ask the money anytime, but borrowed fund which we have borrowed from someone else who are not the owners, they can ask regularly the principal amount as well as the rate of interest. So if we are not able to pay them, they can take any legal action by the court. So because of that, it is more riskier as compared to owner's fund. Finance manager compare the risk and with the cost involved and prefer securities with the moderate risk factor. Cash flow position. The cash flow position of the company also helps in selecting the securities. With smooth and steady cash flow, companies can easily afford borrowed fund securities. But when companies have shortage of cash flow, then they must go for owners fund securities only. Control considerations. If existing shareholders want to retain the complete control of business, then they prefer borrowed fund securities to raise further fund. On the other hand, if they do not mind to lose their control over the business, then they will go for owners fund securities. Flotation cost. It refers to costs involved in issue of securities such as brokers' commission, underwriters' fees, expenses on prospectus, etc. Firm prefers securities which involve least flotation cost. Fixed operating cost. If a company is having high fixed operating cost, then they must prefer owner's fund, because due to high fixed operational cost, the company may not be able to pay interest on debt securities, which can cause serious troubles for the company. So fixed operating costs, if they are high, then definitely company must prefer owner's fund instead of preferring the borrowed fund. So these are the factors on the basis of which the financial decisions are taken. I hope you have understood. The last factor is state of capital market. The condition in capital market also helps in deciding the type of securities to be raised. During boom period, it is easy to sell equity shares as people are ready to take risks, whereas during the depression period, there is more demand for debt securities in capital market. So state of capital market plays a very important role. The condition in capital market also helps in deciding the type of securities to be raised during boom period, and to sell the security at what time, that can be decided. So that is according depression and boom period. What do you mean by boom period? Continuous profit year after year the company is getting, like now the Reliance company is getting. That is known as boom period. And same way, if the company is getting continuous losses year after year, it is known as depression period. So while depression period, for the company it is better to take owner's fund instead of the borrowed fund, and in the boom period it is easy for the company to sell the security shares and take the risk from the borrowed fund. Dividend decision. The next important decision related to investment is the dividend decision. Student, when we are making number of shareholders, when we are making more number of partners for our business, definitely a fixed rate of profit must be decided for each partner of the business, and that decision itself is known as dividend decision, because the part of the profit which we are sharing, which we are distributing among the shareholders, after paying off to all the credits and all the debts, definitely that profit is considered as dividend. This decision is concerned with distribution of surplus fund. The profit of the firm is distributed among various parties such as creditors, employees, debenture holders and shareholders, etc. Payment of interest to creditors, debenture holders, etc. is a fixed liability of the company. Also, what company or finance manager has to decide is what to do with the residual or leftover profit of the company, whether it has to be reinvested or whether it has to be distributed among the shareholders. The surplus profit is either distributed to equity shareholder in the firm, that only I say, of the dividend, or kept aside in the form of retained earning. Why in the form of retained earning? If that surplus, normal profit, above that if we are earning profit, it is surplus profit first of all. Okay. So above normal profit, in that surplus profit part, if we will not distribute and keep as retained earning in the business, Okay, as per the taking consideration from the shareholders, then that profit can be used for the expansion of the business in the future period of time. Under dividend decision, the finance manager decide how much to be distributed in the form of dividend and how much to keep aside as retained earning. To take this decision, finance manager keeps in mind the growth plans and investment opportunities. If more investment opportunities are available and company has growth plans, then more is kept aside as retained earning and less is given in the form of dividend. But if company wants to satisfy its shareholders and has less growth plans, then more is given in the form of dividend, less is kept aside as retained earnings. This decision is also called residual decision because it is concerned with distribution of residual or leftover income. Generally, new and upcoming companies keep aside more of retained earnings and distribute less dividend, whereas established companies prefer to give more dividend and keep aside less profit. Factors affecting dividend decisions. The finance manager analyzes following factors before dividing the net earnings between dividend and retained earnings. Okay. What are the factors which the company have to follow between the dividend and retained earnings? Earnings. Dividends are paid out of a current and previous year's earnings. If there are more earnings, then company declares high rate of dividend, whereas during low earning period, the rate of dividend is also low. So earning is decided as per the company. Dividends are paid out of current and previous earnings. If there are more earning, the company declares high rate of dividend. Okay, whereas during the low earning period, the rate of dividend low. Stability of earning. When we see how the company decide about the stability of earning, companies have stable or smooth earning prefer to give high rate of dividend, whereas company with unstable earnings prefer to give low rate of earnings. Cash flow position. Paying dividend means outflow of cash. Companies declare high rate of dividend only when they have surplus cash. In situation of shortage of cash, companies declare no or very low dividend. Growth opportunities. If a company has a number of investment plans, then it should reinvest the earnings of the company. Has to invest in investment projects. Company has two options. One, to raise additional capital or invest it in retained earnings. The second, the retained earnings are cheaper source as they do not involve flotation cost and any legal formalities. If companies have no investment or growth plans, then it would be better to distribute more in the form of dividend. Generally, major companies declare more dividend, whereas growing companies keep aside more retained earnings. So this is a growth opportunity point of view. As you are getting one by one line clear, I think. Cash flow version, if you are having enough cash flow, definitely you can have high rate of dividend. But if your cash flow is not stable, it is not fixed, in that situation, shortage of cash, companies declare low dividend. Growth opportunity, if you are planned that in the future your company must grow up, definitely that surplus profit cannot be divided as dividend. If instead of that, it can be remained as retained earning. But if the company don't want to have any growth opportunity, then definitely company can distribute the surplus profit as the dividend. Stability of dividend. When we say some companies follow stable dividend policy, has it has better impact on shareholders and improve the reputation of the company in the share market. The stable dividend policy satisfy the investor. Even big companies and financial institutions prefer to invest in a company with regular and stable dividend policy. There are three types of stable dividend policy which a company may follow. Very first, constant dividend per share. It is that as per the share capital the people are purchasing. In this case, the company decide a fixed rate of dividend and declare the same rate every year. Example, 10% dividend on investment. So that is constant, means fixed dividend per share. Constant payout ratio. Under this system, the company fixes up a fixed percentage of dividend on profit and not on investment. Example, 10% on profit, so dividend keeps on changing with change in profit rate. Constant dividend per share and extra dividend. Under this scheme, a fixed rate of dividend on investment is given, and if profit or earnings are increased, then some extra dividend in the form of bonus or interim dividend is also given. That is known as constant dividend per share and the extra dividend. Okay, it is generally given very rarely by the companies, and very few companies are ready to give this dividends. So these are the various forms of dividend, students. One is constant. Every year you will be getting a fixed rate of dividend, constant payout ratio, in which the company fixes up a fixed percentage dividend on profit and not on investment. And second is constant dividend per share and extra dividend. Under this scheme, a fixed rate of dividend or investment is given, and if profit earning increases, then some extra dividend in the form of bonus or interim dividend is also given. Preference of shareholders. Another important factor affecting dividend policy is expectation and preference of the shareholders. As their expectation cannot be ignored by the company, generally it is observed that retired shareholders expect regular and stable amount of dividend, whereas young shareholders prefer capital gains by reinvesting the income of the company. They are ready to sacrifice present day income of dividend for future gain, which they will get with growth and expansion of the company. Secondly, poor and middle income group people, class investors, also prefer regular and stable amount of dividend, whereas wealthy and rich class people prefer capital gains. So if a company is having large amount of retired and middle class shareholders, then it will prefer declare more dividend and keep aside less in the form of retained earnings. Whereas if company is having large number of young and wealthy shareholders, then it will prefer to keep high rate of more in the form of retained earning and declare low rate of dividend. Because wealthy shareholder want to get more profit, because of that they will be ready to invest more dividend in the form of retained earning instead of taking that dividend back. Taxation policy. The rate of dividend also depends upon the taxation policy. If the tax rate is high, dividend will be given low. If the tax rate is low, then high dividend can be paid off to the shareholder. So that only written. If tax rate is higher, then company prefer to pay less in the form of dividend, whereas if tax rate is high, the company may declare higher dividend. Access to capital market consideration. Wherever a company requires more capital, it can either arrange it by issue of shares or debentures in the stock market, or by using its retained earning. Raising of funds from the capital market depends upon the reputation of the company. If capital market can easily be accessed or approached and there is enough demand for securities of the company, then company can give more dividend and raise capital by approaching capital market. But if it is difficult for company to approach and access capital market, then companies declare low rate of dividend and use reserves or retained earning for reinvestment. So this is the part, student. The other two topics I will be explaining in the next class with next topic, that is financial planning. For today's class, this much only. Have a nice day. Thank you.